Despite a 20% decline in the stock market over the past few years, well-known investors like Warren Buffett are preparing for the ride. It is well known that Warren Buffett popularized the value investing approach. A well-known fund manager recently forecast that an impending recession will cause the S&P 500 to decline by more than 20% by the year 2023, which has some people believing that we haven't even begun yet. To be a skilled investor, one must comprehend risk and reward and know when to invest and when not to. Are you equipped to handle any situation that arises? Warren Buffett has been demonstrating to us for years how long-term investments in stocks can be made. He was largely accurate in his analysis of the situation. He has a solid understanding of the art of managing money as a result. He has been sternly advising us to prepare for whatever the market may hold in store in the near future. Warren Buffett does not necessarily disregard the realities of the modern world just because he supports bullish markets and optimistic growth projections. Would you like to learn 5 pieces of advice from Warren Buffett that you can use to strengthen your portfolio's return in the event of an impending economic downturn? You should watch this video if you said yes. 1. Don't get alarmed about panic buying. Always keep in mind to keep your anxiety under control when selling a profitable business. Warren claims that some people shouldn't own stocks because they get upset when the value fluctuates. If you're going to behave foolishly as a result of your assets losing value, don't even try to trade stocks. He gave the example of selling a piece of property. Just because someone gave you a code doesn't mean you should sell it. Prior to making a wise decision, you inspect the house. Warren asserts that stocks and bonds become less risky the longer you hold on to them, and the more you learn about the company you're investing in, even though some people may not be emotionally or mentally ready to own stocks. A bond, on the other hand, becomes riskier the longer it has before maturing. Ben Graham's Mr. Market is mentioned by Buffett. If you have a noisy neighbor who peeps through a fence every day and one day makes you an offer on your home for $800,000, that would be unfortunate. He makes you a $300,000 offer the following day, feeling down and worried about the potential collapse of the housing market. Will you consent to him buying your home? Of course not. You return inside and proceed. Why would you give up a stake in a successful company just because someone else will pay you more? 2. Seize the chances that present themselves. In another statement, Buffett claimed that the stock market was the only place where investors would leave a store during a sale. You should avoid being the one to sell a stock when the fundamentals have changed, because this is a seriously flawed way of thinking. You should sell the shares if it is no longer prudent to hold on to the stock due to the price drop, and the ability of the company to generate cash flow in the future will be irreparably harmed as a result of the price drop. In contrast to the commission of an action, omission. Yes, these events do occasionally cause sizable market declines, but they are uncommon. The most recent significant one took place in 2008. He may assert that it was a significant one, but all it accomplished was to improve the fairness of business valuation. As a result, the vast majority of businesses become inexpensive. As in 2001 and 2002, it was affordable. As a result, given how infrequently that occurs, it is comparable to 2 good chances. 3. Be aware of what you're buying. According to Warren, the idea that one should only trust to succeed financially in occupations in which they are already skilled is outdated. And when he says that he understands, he does not mean to imply that he is familiar with the features of the product or anything else of the sort. He intends to comprehend either the general state of the economy or how the business's economics are likely to change in the future. He also contrasted Wrigley's with the internet. The internet won't alter the way people consume candy. Only the type of candy they eat will change as a result. If you have a significant candy market share like the M&M's and Reese's brand, then those businesses will endure for a very long time. You can predict the number of Wrigley's with some degree of reasonable accuracy, but if you try to predict anything similar, you won't be too far off. The evaluation of the company falls within what you refer to as your circle of competence. You are aware of the economics and competitive dynamic of the industry. Given how frequently companies declare bankruptcy during a market crisis, this is crucial advice. Travel agencies, cruise lines, and airlines have all previously made headlines. However, the businesses that are currently making headlines are those in the technology sector. No matter how inexpensive a company has become, you shouldn't invest in it if you don't understand it. Given how inexpensive it seemed, you might have invested, but that wouldn't have been in your best interests. Since they are accessible during market downturns, you must first be certain that you comprehend them. But before we continue this video's next section, I just want to know what you all thought of Warren Buffett's advice as he forewarns of a fantastic ride that is about to happen. Are you aware of and utilizing the strategies he is using? Are you prepared in case a thrilling ride occurs? Please let us know in the comments section below if the response is yes, so that we can carry on a conversation. Having said that, let's watch the video. 4. Invest in reputable companies rather than cheap ones. Warren asserted that Ben Graham had taught him how to make quantitative purchases, so he set out in search of stocks he called cigar butts. The cigar butt method of stock investing is comparable to looking for cigarettes on the street and coming across a cigar that looks awful, smells bad, and is wet. Once you pick it up, you light it. Disgusting. You throw it away even though it's free. You scan the area in search of another cheap, stale cigarette. This is a mistake since it's much easier to find excellent companies at a fair price. Now, rather than a fair company at a great price, you would choose to buy a great company. You want to be in an attractive business because this time is friendly to them. In the end, compounding keeps doing more business and paying you more money. This, according to Warren, is the enemy of unethical business practices. 5. Specialize in long-term goals. According to Warren, there will be things in your life that you won't be able to believe, and this is also true of the stock market. Long-term performance of the nation will be exceptional, but if you maintain your objectivity, you will see enormous waves. You won't need to be especially intelligent during that if you can emotionally separate yourself from the herd and become wealthy. You should be aware that it simply requires no brains though. Temperament is required when the markets crash. If you think about it, the market will decline more quickly the more people try to sell all at once. Therefore, you must be the type of person who puts off worrying about the upcoming week or month and thinks their investment in the market will still be up there in a few years. If you can pull that off, investing during market crashes gets a whole lot easier. Just keep in mind to consider the big picture.